What exactly is a bond? Well, a bond is considered a fixed income investment, and fixed income just means that you can expect to receive a steady stream of income. When you buy a bond, you are considered a lender or even referred to as a creditor or debt holder. Basically, you are letting a company borrow your money for a certain period of time, and in exchange for that, they agree to pay you an annual interest rate. You can think of it as an IOU. So let's just give an example. Say I have $10,000 that I want to invest in bonds. Now, bonds are issued in set dollar denominations. Corporate bonds are usually $1,000 per one bond. So I have $10,000, so that will get me, I can purchase 10 bonds. Now, these are going to be 5-year bonds, and the annual interest rate that they have agreed to pay me is 4%. So I will make $40 a year per bond that I own for a total of $400 because I own 10 bonds. Now, at the end of 5 years, that company is going to pay me back my initial investment of $10,000, and over those 5 years, I will have earned $2,000 worth of interest. Now, there's also many different types of bonds, but I'm just going to quickly cover the 3 most common, which are corporate, municipal, and U.S. Treasuries. Corporate bonds are issued by private and public companies, and usually they issue these bonds because they need to raise capital for something or they have a project they want to do. Municipal bonds are issued by state and local governments, and they're also used to fund projects like building libraries or bridges or upgrading a park or making a park in a certain area. Now, these bonds, municipal bonds, are very popular with individuals in high tax brackets because the interest from these bonds is tax-free. And lastly, there are U.S. Treasury bonds, and these are issued by the government for government spending. They're backed by the full faith and credit of the federal government, so they're actually considered one of the safest investments that you can make. Every bond also has a credit rating, and that's just a rating based on the strength of the company and the likelihood that they are to stay in business or that they would default. So if a company does not have a good credit rating, they have to do something to entice investors to take a risk on them, right? Usually that means that they have to pay a higher interest rate to get you to take the chance on investing in their bond. Those are known as high yield bonds, or even some people call them junk bonds. So even though bonds seem less risky than stocks, there are some risks associated with them, and we're just going to cover those real quick. There's credit risk. We just talked about that. There's the risk that you might not get your money back if the company defaults. Now, it's important to know that you are a creditor of the company, so you are in line to receive your money before shareholders, people who own stock in the company. There is also interest rate risk. As interest rates go down, bond prices go up, and then vice versa. As interest rates go up, bond prices go down. So you run the risk if you need to sell your bond for any reason that you might not get what you originally paid for the bond, depending upon where interest rates are at that time. There's also inflation risk, and this is just the risk that inflation is outpacing the amount of interest you're receiving on an annual basis. There's liquidity risk. Hopefully you plan to hold your bond until maturity, till that term is up, but if there's a chance that you need to get out and get your money, you may not be able to sell the bond. There may not be anybody to purchase the bond, and the company is not going to pay you back the money earlier than they had planned to. So there's liquidity risk involved. There's also call risk. Some bonds have call provisions, which means that the company can pay you back earlier than the term if they decide to. So you may have a 5-year bond and they decide they want to pay you back after 2 years so they can stop those interest payments. Well, what happens if you want to reinvest that money into another bond, but interest rates are lower? You're going to receive a lower interest rate than you were getting with your initial bond. That's also known as reinvestment risk. So Even though there's some risk involved with bonds, we certainly believe that it's a great investment to have as part of your portfolio. It adds diversification, and investors like the predictability of bond. They like the steady stream of income that bonds give them, and then there's also individuals that love those municipal bonds for the tax benefits that they offer. There's lots more that we could talk about with bonds, but that's it for today. You can always contact us at 586-799-6099 with any additional questions that you have. Thanks. You guys have a great day.